thank you for joining us on this month's edition of Making Sense of the Markets with Chris Kerlow and Team LWC. My name is Mitchell Shields. I'm the financial planner with Team LWC, and I'm going to be moderating the session today. So I just wanted to kind of give a quick introduction as far as what the topics are going to be that Chris will be discussing. And then we got some questions in the registration. We're going to go over those questions at the tail end of the session. And of course, any questions that come up through the session, I'm going to be watching the question and answer section of Zoom. So just throw your questions in there and I'll make sure to address them with Chris at the end of the session. So we titled this month's presentation Bottoms Up or Bottoms In. Chris is going to be talking on a few different topics on our session today, starting with some comments on the Fed, slowing down but not pausing. He's going to take some time on the energy sector and also the Canadian banks as we come into the earnings season there. Going to touch on the labor market if it's still too hot to touch, and then go over some general portfolio positioning when it comes to how we're managing your money here at Team LWC. So without further ado, I'm going to pass things over to Chris Kerlow to take it away.
Thanks, Mitch. Appreciate it. Welcome, everybody, to our March edition of the Team LWC Making Sense of the Markets. This is our standard disclaimer slide, and we'll just jump right into it. So both the Fed and the Bank of Canada have indicated that they're going to be slowing their pace of play, meaning the rate hike cycle. The BOC actually indicated that they'll probably be pausing, but the bank across the pond, or just down south from us, I guess, the Federal Bank of the United States of America is expecting another 25 basis points. And most recently, with the hot labor market data, as well as stickiness of inflation, we've seen actually the chances of a rate cut by the end of this year coming off the table. It had gotten to as high as 3 possible rate cuts by the end of this year, meaning that the market was anticipating a possible slowdown as we moved into the back half of 2023. That's no longer on the table. Markets were seeing a light at the end of the tunnel. You can see here by the chart, this is October. This is the end of the year. Markets were kind of rallying alongside bonds and the US dollar from about October into January. We had almost a 10% rise in the NASDAQ, 7.5% on the TSX. And then unfortunately, things had reversed. About 3 weeks ago, we saw bond yields begin to rise, that fear trade and the dollar start to reverse, and both the TSX, the NASDAQ, and the S&P 500 all kind of reversing course, giving back some of those earlier gains. On a more positive note, though, this chart on the bottom right is indications by the IMF, the International Monetary Fund, on their expectations for growth over the next several years. You can see that both Canada and the United States narrowly skirt by a technical recession, that meaning negative GDP on an annual basis. The Euro area as well. That doesn't mean that we're not going to have some sort of a landing. The Fed and the Bank of Canada definitely need to institute some sort of economic slowdown here to get inflation under control. They have a dual mandate of inflation as well as full employment. We'll talk a little bit about employment later, but in Europe, they actually just have one mandate, that's fighting inflation. We've seen German Bunds actually expecting about a 4% terminal growth rate. It's quite a bit higher than we are here today. You're thinking back just not even 2 years ago, there was a negative yield on those bonds. So things have changed quite a bit here. And we're seeing a bit of what's defined as stop and start economics. You think back to the pandemic, we had a massive influx of monetary easing, kind of paying off debts, bringing a lot of money to the table to help the economy. And now fast forward a couple of years later, and we've had the fastest rate hike cycle that we've seen in modern history. And that's been weighing on markets. 2022 was a challenging year. 2023 started off quite well. And now we're in this bottoms up or bottoms in environment, meaning bottoms in. Have we seen that low, or are we about to see the bottoms kind of go up in the stock market? That really puts a strong position and rationale behind active management. The reason why we continue to move around in our portfolios. I'm going to talk at the end of the presentation about some of the changes we've made more recently on how we're taking advantage of the opportunities that we're seeing here in the market. Quickly on the energy side, the chart on the top right here is showing you the CapEx to revenue. You can see that this is the lowest it's been in over 2 decades. Typically, you see about 11 or 12% of revenue being spent on capital expenditures. But with current government policy, energy companies have been slow to move into that investment phase, and that's caused a big distortion. And we think even though energy prices have been at the bottom end of this range, around $70 to $75 for the past few months, the prudent spending actually makes those companies quite profitable and in a good position here. We actually most recently added Topaz Energy to the LWC Canadian dividend portfolio to take advantage of some of the weaker energy pricing. That's mostly on the natural gas side. We remain long Enbridge and TransCanada Pipeline. They're the energy midstream moving that energy around the world. And on the US side, we have LNG and Oxy. All have struggled a little bit as energy prices have moved lower, but we still see them as a good inflation hedge and positive headwinds setting up for the year to come. The US SPR is at a 35-year low, can't go much lower. If energy prices did come back into the 60s, President Biden has indicated that they'll be likely filling that back up. China reopenings bringing back almost a third of the world consumer to energy consumption. And then Russia was oversupplying the market as they saw some sanctions hitting their distribution avenues. And now that's kind of peeled back a little bit as well. And obviously the decarbonization agenda is out there and has been the catalyst for this massive underinvestment. There's been over $3.6 trillion spent on alternative energy over the last decade. That's only brought our hydrocarbon usage down from 82% to 81%. So still a long way to go there. That makes us extremely positive on the materials space. We added Freeport-McMoRan, one of the largest copper producers in the world, to our portfolios recently. Remain long Barrick Gold. We have a good outlook for the space. We're looking at some lithium ideas and cobalt. So stay tuned for those in your email accounts. And we think that is just another massive space of underinvestment to achieve our climate goals by the COP27 in the years to come. So materials is probably one of our top sectors as we look out into 2023 and beyond. So right in the middle of bank earnings season, talked about this morning at BNN. We'll send out that replay with this one later if you missed that to catch that. Bank of Nova Scotia, we own that for a lot of our portfolios. Unfortunately, been a bit of an underperformer here, but looking long term, still really positive on the name. They have one of the best relative values across the major banks. Trading revenue for BNS, Royal this morning, likely even TD tomorrow, all coming in better than expected. But what's been happening is these credit loss provisions keep dragging down earnings. So in 2018, the regulators changed the accounting rules so that you need to account for bad losses as you expect them to happen in the future before they're even realized. In the pandemic, we obviously saw bad loan expenses rise through the roof. The big banks collectively raised about $20 billion in these expense charges, which about $2 billion of which came to fruition because of the government bailouts that came in place. We're seeing that rise again. We've seen a doubling in the bad loan expenses at Scotia, a quintupling at Royal Bank, and aggregate, this has kind of been tripling for the next few years, pricing in what could be as bad as the great financial crisis. We really don't see that happening. We're more in this soft landing camp. And likely that could be future earnings as those get released, as those bad loans don't come to fruition. That adds earnings right back to the balance sheets of these banks. Concurrently, we've seen really weak capital market support. Outside of this trading revenue that was high this last quarter, that tends to be a little bit transitory. Capital markets activity has been benign, so that could come back. Scotia's ramping up their experience there. We have another position in TD Bank. They have a really good capital markets division as well and benefit from a strong U.S. economy, net interest margin expansion in the States that continues to rise as Canada's kind of been put on pause. So really positive on TD, and we'll see what happens there tomorrow with their earnings release in the morning. Labor markets are still too hot to touch is how I titled this slide. what that is implying that it's too early for the Fed to back down. Unemployment is at the lowest level since 1969. Looking back even further, if we tick down just to 3.3, 3.2%, that'd be the lowest level since the 1940s. And so, everyone has a job. You're almost 1.7 jobs per people looking for it. The labor market participation is pretty high, and productivity is falling. So we saw the PCE report, that's the inflation report, come out last Friday. Again, startled the market. It's almost, and there's a little bit of this good news is bad news. Good news meaning that positivity and great things for the economy and the market are shaking the market, because it means that the Fed's likely to go longer with this rate hiking regime. We're not looking for that pivot to when they go from hiking rates to cutting rates, more just that pause and letting these things roll through the market. There's going to be some challenges. Lending is going to be more expensive. There eventually likely will be some challenges in the labor market, but without that, and we don't get this soft landing, you kind of get this like pivot where people think it's coming back to normal, and then the Fed has to lean into it yet again. And that's the last thing we really want to see. We want to kind of get this over with, move on, and work through the back end of this. And equity markets, just so we all remember, are forward-looking instruments and something that investors need to remain invested in and allow us to kind of move around the edges as things continue to pivot in the market. With that, I'll kind of touch on some of the changes that we've made over the last quarter to reflect a lot of the things that we've just been talking about. We're not just sitting here kind of static. We continue to monitor our portfolios on a daily basis. This first trade is a little bit on the edges in our alternative bucket. We're trimming the Purpose Ether Yield Fund. It was a smaller position, but it's risen about 30% so far year to date. Any kind of move like that, you'll likely see us taking some profits off the table. Still maintain a small position in that, and we're pivoting that into the Wavefront Managed Futures Fund. This is a tail risk strategy, tends to do best in really strong markets and really weak markets. In the middle, it's not really where it's designed to be, but in that space, we should be all right. But we see the bigger risk kind of in those two tails, in that bottoms up or bottoms in mentality. If the bottom's in and we rip higher, these guys should do quite well. And if we move the other way, this should provide some portfolio protection. Managed futures are a bit of a complicated strategy. They basically look at asset classes all over the world, from beyond stocks and bonds, it's part of it, but also hog futures, cattle, cotton, wheat, gold, silver, lithium, just trying to move with the momentum, and designed typically for institutions and pensions. But it's something I've followed my whole career. I've done an extensive amount of due diligence on this company. We might even have them on at a future date to give us a debrief into that, and invite them to our investment committee meeting in the future as well, to get their insights as they manage a global portfolio as well as a specific strategy. Another move that I think will help us understand, where the world's changed. We're moving out of our global high dividend strategy to the Horizons International Developed Markets solution. Biggest change there is the US weighting. Global dividends, the benchmark has about 2/3 in US stocks, just because the US market's the largest stock market in the world. And so by doing international versus global, what that basically means is no US. So the big move here is out of the US into international developed markets. Think Asia, Southeast Asia, Europe, Japan, Australia, Switzerland. These markets have really underperformed the US over the years past. This isn't a major move, but it does move along the edges. Secondly, the Global High Dividend Fund had a covered call overlay on it. What that means is that it writes calls to enhance the yield. So we are giving up a bit of yield here. That product had a 7.6% yield. A bit of it was an enhanced yield. We still have a nice 3.77% yield on HXDM. But why we're okay moving off of that, Ether actually had a covered call overlay. Another part of what we're doing right now is reducing that. And the rationale behind it is volatility's come way down. Up until these last few weeks, it was trending below 20. Over the past year, we realized about a 24% volatility in the S&P 500. So we want to capture some of that by writing calls into it. With volatility a bit lower, we decided to take that off. I'll prelude that these changes were made fortunately a couple of weeks ago, so it's been positive so far as we've seen weakness kind of since then. And then it was a question, but I'll bring it up at the question section. I'll bring it up now just because it's being the recording. But basically, another reason why we're a little bit more opportunistic moving into international equities is cash in the States and in Canada is yielding close to 5% on short-term government bonds. And so that kind of sets a bar. You need to be like, okay, I could get 5% on cash, US govies, or invest in stocks. So stocks need to be 5% better. In the US, you only have about a 1.3% dividend yield. At least in Canada, we're closer to 3 on just kind of waiting. And so you have that aspect. Second of all, following the pandemic, you had a lot of investors borrowing to invest. Now, if you're borrowing, that's costing you another 5% to just get that cash plus the VIG that the company is going to charge you to borrow. And so that's another hurdle you need to overcome. And then lastly, if you're a foreign investor looking where to place cash around the world, but don't want to take the currency risk, you need to hedge that away. Simply put, your hedging cost is the difference between that currency, let's call it the US rate at about 5%, and your local domestic currency. And so you add all these up, and it's a pretty high task for stocks, particularly with the backdrop we see. So that's the reason why we think we'll see more flow into Europe, strength on the European currencies, which will translate to better returns for us domestically. And just another move that we made. And then lastly, we're trimming our floating rate income fund in favor of the Horizons Cash Maximizer. Again, we're getting close to 5% on that Cash Maximizer. Really cool product. It's an advent as to why people always want to look at historical returns. Something like this didn't exist before. It uses a corporate class structure to recharacterize the income, that 5% income, into capital gains. And then it gives us some dry powder. Should we come back lower, we could trim out of this position, redeploy into equities or higher beta names and capture some more upside return. While we wait, we're getting 5% on our money. So we're really excited about that. Releasing the CI floating rate note adds a little bit of duration. Floating rates actually have negative duration. So we're adding duration by removing this, a little bit complicated. And secondly, it has some credit risk. So we're taking credit risk out and putting duration in. It's a bit of a defensive move. All in all, these changes have been a little bit defensive. We don't make big changes in or out. We look at each client's goals and manage towards those goals. But we wanted to be tactical in this environment. After such a strong run in January and the start of February, by mid-February, we decided to come off the risk bucket a little bit, move more into alternatives out of equities, and change our fixed income out of credit into duration. And so all of that adds up to a bit more defensive, but puts us in a position to move back in should we have a bit of a move lower, as we don't really see this as a hard landing. After a tough 2022, we think there is some good opportunities out there, and continue to search for those for you, our clients, and manage your portfolios to achieve your long-term goals. So thank you for listening.